great to have you all here via Zoom again. Just a reminder, really appreciate your questions. Feel free to ask them at any point during our presentation. We'll either answer them as we go along or alternatively at the end of the presentations today. This year end for corporates represents something a little bit unusual, I guess, in that for many years, certainly from a tax perspective, year end planning has been around some fairly familiar subjects of making sure that deductions are incurred as you'd expect, planning for tax, which is ultimately payable. Certainly our economic environment at the moment has added a few novel elements for tax planning for corporates for this year. And I thought it would be useful to touch on some of those. Certainly what we are experiencing in talking to our clients at the moment is that many clients have had quite a successful first 6 to 9 month period in terms of corporate activity. And then for that last 3 months, there's quite a variation. There are some clients who have had a business as usual case, some clients for whom business has very much declined significantly, and some businesses where there's been a decline, but equally there have been the inclusion of schemes such as the JobKeeper and the cash boost, which has certainly assisted or bolstered cash flows. So what I'll run through in a little bit of detail today is not just those things that are new for this year, but also how that unique economic circumstance affects people. So I'll touch on that in the last slide when we wrap up today in terms of looking towards September. Now, a lot of interest has come about and a lot of activity around the JobKeeper wage subsidy scheme that many clients have qualified for. That is the one which pays for $1,500 per eligible employee or per business participant for each fortnight. And for those who are already participating, it's sort of well understood how that system works, but it does take an aspect of continuous reevaluation. First, if you have already qualified for the JobKeeper scheme, to work out how many eligible employees you have. And once you're in the JobKeeper system, you tend to stay in there and continue to be eligible over time. But one thing that I think has is a continuous refrain in all of the media that you see at the moment is the tax office reminding taxpayers that they have to be really careful about the level of compliance, substantiation and documentation that they keep in relation to JobKeeper. Originally billed as being $130 billion worth of support provided to businesses, and that substantially means corporate taxpayers. I think it's fair to say that because the tax office is essentially designed as a revenue raising organisation, the prospect of it actually providing revenue to businesses is a fairly short run event. We can expect a business as usual approach from the tax office, both during the JobKeeper phase and also coming out of it. So our focus is very much on assisting businesses to make sure that in terms of all the fundamentals of documentation that would indicate some kind of a risk if they overclaim their JobKeeper amounts, they do maintain enough documentation for it. And some of the areas that we have got ourselves involved in is looking, for example, at eligibility of particular employees. There's a declaration that all employees have to complete, but that doesn't completely get employers out of the mix. Our experience is that employees are very keen to sign on an eligibility for JobKeeper, and often employers are very keen to get that form back from employees, but that doesn't mean in all cases that the employee is always eligible. If you don't satisfy the permanent residency criteria, the visa requirements, or employment was not in place on the right date, which is early in March, then you can find that not only have you claimed ineligibly for an employee, but that's an error that gets rolled forward and continues on for a full 6 month period. And what we see as being a real risk there is that if you have an ineligible employee for each one of those, if it runs all the way through to September, you're potentially looking at $20,000 plus penalties for each one of those employees. A really challenging aspect of the JobKeeper regime has been the ability to, I suppose, forecast a decline in turnover so that you get into the scheme as quickly as possible. And by its very nature, trying to come up with a forecast of what turnover for a business is has risks attached to it. So particularly where we have businesses that are pretty close to that 30% turnover drop, or for some businesses 50% or 15% turnover drop, it's really important that whatever assumptions or forecasts that were made, that they're really carefully documented at the time you make the declaration to the tax office, so that as and when you do get a review from the tax office, you're able to show that there was the right level of substantiation, the right level of analysis conducted at the time that you're making these declarations. Of course, JobKeeper is not the only aspect of year-end planning, but some of the complexities that we have seen with JobKeeper, for something which seems to be quite a simple scheme, a lot of us know the essentials of it, there are a raft of different parts to it that are really quite challenging in practice, or throw up issues that make it simpler than it first appears. Some of those relate to visas. There's only one category of visa which is actually for which people can be eligible. That's the category 444 for New Zealanders only. And so it's very important for you to, from an employment law perspective, understand the visas and the rights that people use to be able to be employed, but also that that's carefully assessed in terms of the JobKeeper requirements. If you're not a 444 visa holder, you are ineligible for the JobKeeper, and it's very important to not claim for those employees. Some of the issues also relate to the requirement that a person be employed on the 12th of March. Now, some of the issues there are, we've encountered are, especially if you have frequent turnover or employees coming on or going off around that key March date, is what exactly comprises the start of employment. So, for example, if you've made a job offer to an employee and they've said that they're going to join up, or even if they have signed on, does that employment commence at the time they actually have their first hour of work, or in fact, does it run back to the time at which you entered into the employment agreement? And that can be, in a number of cases, if you've employed and put a couple of new people on over the start of March, that can actually result in quite a big difference in terms of what your overall JobKeeper claim is over the life of the scheme. Turnover calculation of itself can be a bit of a challenge. The basic test can be applied either on a monthly or a quarterly basis, but turnover and estimating turnover and what exactly that means can be complicated, especially if you're not just simply providing taxable supplies, but if you've got export supplies or input tax supplies. Input tax supplies are completely excluded from the JobKeeper scheme. A real challenge for some taxpayers and some of our clients has been, if you only make input tax supplies, you actually, technically speaking, have no turnover and therefore can't get into JobKeeper, which is a real challenge for those businesses because they often will feel the downturn from coronavirus at least as much as other businesses. The alternative tests available for corporates, in particular for startups. Startups are a particular challenge for qualifying for JobKeeper, simply because the basic JobKeeper scheme compares your turnover for this year versus last year. Now, if you're in a phase of rapid growth commensurate with being a startup, it can be really challenging to actually satisfy the tests to actually get it into the JobKeeper program. One thing that we think is a particular issue in the larger corporate area is the use of service entity arrangements. The JobKeeper is originally announced, looked at just the turnover of the entity of a business, where if, commonly with corporates, we see the use of service entities so that they can, for example, have a single employer entity within a corporate group, and that can supply services and employment services to a range of different entities throughout the group that actually conduct separate businesses. The JobKeeper as it stands now essentially doesn't take into account the possibility that the entity that employs people can be different to the entity that actually conducts an outwards facing business. And what that can mean in some circumstances is you're not actually able to compare the entity that has the decline in turnover, that's the customer facing outwards business, with the entity that has all the employees in it. That's a particular challenge. A sleeper which hasn't got, I think, nearly enough attention at the moment is the inclusion in the JobKeeper of a series of specific anti-avoidance provisions. And the reason I mention that one is, especially for any clients who have had a decline in turnover which is close to the threshold, we expect that there will be attention from the tax office for those type of taxpayers. and particularly around situations where businesses have sought to achieve a particular turnover drop outcome. That is, for example, one thing you might have heard in the market, or even seen some suppliers take up this approach where they are, typically speaking, not making supplies at the end of a particular period in order to qualify for JobKeeper. Well, that is just an example, I suppose, of where I expect the tax office will pay particular attention to the variations in the level of suppliers and how much income is being recorded by businesses when they get right to the end of a period in which they are declaring that they qualify for JobKeeper. And a key risk there would be if the tax office sees a business which qualifies in 1 month and then has a very significant increase in revenue in the next month. I'd say in those kind of cases, there's a reasonable chance that, one, you'll get some attention from the tax office, and two, it'll be really important to evaluate the commercial and reasons why that change has happened, and make sure that you can show why that doesn't relate to some kind of a scheme to manipulate turnover. Can I go over to the next slide, please, Nicola?
Did you want to answer the couple of questions that have just popped through?
Yeah, I will actually.
So just because they're related to JobKeeper at this stage.
Yeah, so the question I've got here is, how do I treat an employee who qualified for JobKeeper and now has gone on paternity leave for 4 weeks and is claiming paternity payments from Centrelink and then will be back at work after the 4 weeks? That's a good question. Thank you for that. So they will become ineligible for the period of paternity payments, but would remain eligible for the other periods for JobKeeper if they satisfy the other eligibility criteria. So, for example, the employment criteria in March. Okay. Does JobKeeper need to be recorded as a payment under single touch payroll? Yes, it would. So the JobKeeper of itself, the receipt of the JobKeeper, it is not an STP payment, but yeah, generally speaking, the best way to record eligibility for JobKeeper is through the STP system. Okay. At this point, I'll pass it over to Lauren to talk about rent relief and the instant asset write-off.
Thanks, Joel. So rent relief for commercial tenants, I thought we'd start that first. So as part of the COVID relief measures, the government introduced a compulsory code of conduct for commercial SME tenants. They had to have an annual turnover of less than 50 million and they needed to meet the eligibility requirements for JobKeeper. So as we approach year end, we must start to think about how we account and how we claim the deduction for any deferrals or reductions that have been received. So Kinh will discuss the accounting treatment following me. So I thought I would just cover the tax. So for tax purposes, it really depends whether it is a rent deferral or a permanent reduction. And I thought the best way to discuss these changes was using an example. So if we usually pay $100 a week and the tenant has been provided with a $20 deferral and a $10 reduction. So even though we only pay $70, we are contractually obligated to pay $90 for the use of the office space in that week. So regardless of whether we are required to pay it now or in 6 months' time, the expense is still certain and due and payable. So as a result, we claim the tax deduction of $90. That means that the $10 rent reduction, we don't claim a tax deduction on. However, if the rent reduction has not been formally executed and the contract hasn't been amended, then the rent deduction is $100 still. So moving on to the instant asset write-off. So previously eligible businesses with aggregated turnover of less than $50 million were able to take advantage of the instant asset write-off concession for assets costing less than $30,000. And previously this measure was up until 30 June 2020. The government has since extended the instant asset write-off for 6 months to allow eligible businesses with aggregated turnover of less than $500 million to immediately deduct the cost of a depreciating asset costing less than $150,000. So that's quite a jump. So there's a couple of things to keep in mind with this. And so to take advantage of this concession, the first thing is that the asset must be first used or ready or installed ready for use after 12th of March 2020. And it must be first purchased and ready for use before 31 December 2020. So assets first used from the 2nd of April 2019 to 11 March 2020 will be subject to the old rules. So the previous threshold of $30,000 and turnover of up to $50 million. However, the ATO has said that if you first purchase the asset before, but then first used it after, then you can still take advantage of the $150,000 limit. The second thing to note is the $150,000 is exclusive of GST if the business is registered for GST. Third, the asset doesn't have to be brand new. It can be secondhand. 4, remember that the $150,000 limit is reduced by the car limit. So previously this wasn't something we really had to worry about because the $30,000 was always less than the car limit. Now we have to take it into consideration. So if you purchase the car after the 12th of March, but before 30 June, but you purchased it before 30 June 2020, the most you can claim a deduction for, the instant asset write-off is for $57,581. If you purchase the car after 1 July 2020, but before 31 December 2020, the most you can claim is $59,136. And this must be the business portion of the car. The fifth point I wanted to raise was that the concession is only allowed where you are the economic owner of the asset. So this is important where you have a chattel mortgage, an HP arrangement or a finance lease over a recently acquired asset. So to simplify it, if you aren't already claiming a tax deduction on these class of assets, then you won't be able, for any new purchases, then you won't be able to claim the instant asset write-off. And lastly, eligible businesses need to bear in mind the aggregation rules. So you need to consider the businesses that are connected or associated with you when you're determining if the aggregated turnover of your business is less than 500 million. This means that significant global entities will not qualify for the instant asset write-off. So I'd like to pass you on to Kinh, who will give you a financial reporting update. Thanks.
Afternoon, everyone. Thanks for joining us today. I'd like to just run through some financial reporting, I guess, as corporates head into the end of the financial year. What it is that we are setting up to do in terms of confirming our numbers and essentially what are our reporting obligations. I think it's a good chance looking forward to take stock of making sure we're across certainly what our reporting requirements are and then planning ahead what might change given the changes in accounting standards. So the first one I'll touch on is under the Corporations Act, there was a change announced by ASIC. It was a bit of a surprise to the market, March 2019, that from 1 July 19, the definition of a large company, thresholds were going to double. So essentially revenue threshold of 25 million became 50 million, total assets of 12.5 million became 25 million, and employee numbers from 50 to 100. So if you ticked 2 of those 3 thresholds, you were then defined as large. Now, bear in mind that is your consolidated assets and revenue. So certainly, whilst you may not apply AASB 10 being the consolidation standard, you need to apply that standard under the Corps Act to determine if you do actually meet the definition of a large company. Now, I raise that firstly, I guess if you look back when ASIC made that announcement, then, you know, for some years, Australia economic environment, there's been a lot of growth, and certainly companies have grown and revenue, assets, employees have grown, and they have increased that threshold. Certainly with COVID, that may look like, you know, it's not going to be so relevant. That is, some companies may well have experienced some sizable drops in their revenue and assets, but nonetheless, there are others that may be still growing. As Joel had alluded to, some of our clients are still performing quite well, if not better, under the current circumstances. So I suppose it's important to just look at what are your levels right now, or perhaps what will they be in 6 to 12 months, because perhaps in 6 to 12 months you're looking at falling into that space where you do need to report under the Corps Act. The other consideration there is some new accounting standards have come into play. Last year was WSB 15, revenue from contracts with customers. So you mightn't think immediately that that's going to create some additional assets for you, but under that standard, contract assets can arise, which is essentially those sorts of costs that you otherwise wouldn't incur in securing a contract as defined under that standard. So it's essentially, in some ways, some deferral and spreading of those costs that otherwise would have hit your P&L. Now, they may not be large in some entities, but it is something to just consider. And certainly with the new standard that's come into operation this year is WSB 16 leases, which I'm sure a lot of you are having fun with in implementing this year. So with the essentially bringing on balance your operating leases, treating them effectively as a finance lease, your right of use asset can be a material asset, an additional asset on your balance sheet. So again, just looking at whether or not, firstly, correctly implementing that standard, which takes a bit of work, but then seeing, well, what has that done to your total assets? Because that may be enough to push you over again into large. Now, what if you're a company which has actually experienced a drop in revenue, assets, employees, such that you're no longer considered large? I suppose the consideration there is, do you still, I guess, for example, if you have an audit obligation there as large, do you still conduct your audit in the year? Do you complete your accounts and say they are prepared on a true and fair basis as a large company? I suppose, there's a number of considerations there, which is, are you likely to return to being a large in the subsequent year? For audits, it may not just be the pure regulatory obligation that you're fulfilling there, but it may be to satisfy any lending requirements, shareholder agreements, or on the near horizon, you may be looking at a transaction or an IPO or an exit strategy. So certainly the answer is not always going to be a matter of, well, I don't have to and then I won't, but I guess you just want to consider all those relevant factors there. Next, I wanted to touch on the removal, in the future that is, of special purpose financial reports. So for a long time now, we've enjoyed the luxury of special purpose financial reporting. But in March 2020, the WSB completed a major milestone after issuing some exposure drafts, which effectively marked the partial, I'll say, end of special purpose financial reports. And I say partial because it applies firstly only to certain for-profit entities. And I say certain again. So the key is in which entities does this apply to. So firstly, it applies to companies which are legislated to prepare accounts under the Australian accounting standards, or proper case there, or accounting standards, as the legislation may refer to. So take, for example, any company under the Corps Act that is required, large companies, or small foreign-owned proprietary limiteds, managed investment schemes, etc. Sorry, I just lost my spot there. And secondly, if they have a constituting document, or in this case, it may be their loan agreement, which governs that they need to prepare accounts, and if that document was created after 1 July 2021. So that's an important distinction there, because say, for example, I currently have my accounts prepared, special purpose accounts, and I'm not a Corporations Act entity, a trust, privately owned trust, but I prepare accounts. Then provided your trust deed that requires the preparation of accounts was prepared and not modified after 1 July 21, then you can continue to prepare special purpose financial reports. So obviously the key there is have a look and understand what your obligations are. Think carefully about whether there is an alternative way if you were looking at altering your trust deed. and also in any new lending arrangements that you secure, because I suppose a lot of the reporting requirements outside of the Corporations Act is driven by reporting requirements under finance arrangements, is whether or not those accounts stipulate that they need to be prepared under the Australian accounting standards. So again, when I say Australian accounting standards, in proper case, Australian accounting standards, they make a distinction where if you just say accounting standards, my understanding is that does not apply in terms of having to mandatorily prepare general purpose financial statements. So when I say general purpose financial statements, this is also general purpose financial statements for Tier 2 entities, which will actually apply simplified disclosures. So we should all be familiar with the reduced disclosure regime, which certainly removes some of the more onerous disclosures that listed companies enjoy dealing with. But the simplified disclosures is going to be more akin to your reduced disclosure requirements with some changes. If you fall into this, I guess, new regime where you do need to prepare general purpose financial statements, then the consideration there is if you didn't previously apply, for example, the key standard is AASB 10, which is the consolidation standard. I guess there's two schools there, school of thought, which is, one is this is a disclosure standard, so I don't need to comply if I'm preparing special purpose. The other school of thought is that it is a recognition and measurement standard, and therefore you must apply, and therefore you would consolidate in preparing your accounts. Under the general purpose financial statements simplified disclosures regime, then that standard must be applied. So I suppose on adoption, you'd be looking at potentially consolidating within your financial statements entities information that you otherwise haven't done in the past, and that can be a mountain of work. Now, this standard applies from 1 July 2021, and it can be early adopted if you elect to do so. Now, the large carrot, I'd say, that's been dangled in front to incentivize anyone to early adopt is that if you do make that adoption, there is no requirement to make a restatement of your comparatives and essentially adopt, for example, AASB 10 and any other standards you hadn't applied with previously in the year of adoption. And alongside that, you can also elect to make any of the changes disclosures around adopting a standard that you say hadn't applied before. Let's say, for example, AASB 2, share-based payments. So, for example, you now adopt that standard, recognition and measurement, and that has an impact. You can essentially include the effect of that adjustment with your adoption of the new general purpose financial statements disclosure standard. Now, hypothetically as well, if you found that you should have been complying with AASB 2, but you hadn't been, and that was actually an error, then you can also include that as part of your transition adjustments without, I guess, drawing attention to it. So something to think about. It's certainly, I suppose, a reason why that transition relief was provided, really just to get the early adopters making that change. Moving on, I suppose I was thinking around with year end, you know, it's with the strike of COVID, a lot of working from home, myself working from home, there was a good chance to do some housekeeping. And I thought, well, with the year upon us and the year ahead with the changes, and obviously I'll talk about what the COVID-19 impact has been. We've had a lot of seminars covering, I guess, that impact. I thought it'd be a good opportunity for CFOs, CA, finance managers to take stock of their accounting policies, their systems and processes. When was the last time there was a proper refresh of what those policies look like? Are they still applicable? Do they best reflect how the business now operates, given whatever changes have occurred in the business, regardless of COVID or because of COVID as well? When I think about the changes in processes that may have arisen working from home, I suppose there may be some more or an increased requirement for sharing of roles. So it would only benefit any organisation to ensure that their processes are well documented so that they are transferable to other employees, essentially to ensure that whether it be the financial reporting or the operations of the business remains efficient. Next is COVID-19 impact. the list I could write for this in terms of the financial reporting impact could go on and on. But safe to say, given COVID-19 for 30 June 2020 year ends, certainly for 31 December year ends, it was a material subsequent event, and there's been a lot of talk and disclosures required, or I guess volunteered in those accounts around what the impact has been. In discussions with the Institute, the seminars they've held with working groups, there's been a lot of talk around what sort of disclosures are appropriate. Certainly, the more the better in terms of showing the uncertainty there, you know, just articulating in terms of the board's or management strategy in dealing with the uncertainties and what it means for the business, especially from a going concern perspective. If I think about the financial disclosures, I think about the financial risk management disclosures required by HLB 7. So they specifically are looking at, you know, credit risk, your liquidity risk, and your market risk. Depending on what sector of the business you're in, I would say each one of those would have been affected by COVID-19. Now, if you are, in fact, a special purpose financial reporting entity and HLB 7 doesn't apply, or you elect to not comply with it, then it may be a useful standard to refer to I suppose, understand what sort of risks that you may want to highlight in this year's financial report, whether it be in the director's report or in the financial statements themselves, just to help the users understand where the volatility, the risks and the uncertainties are, or more so where the critical accounting estimates, what may have affected them in the year. So certainly when you're looking at fair value measurement and impairment, you know, whether those prior methodologies used in the past remain appropriate, whether the key assumptions and inputs that were readily attainable in prior periods in December, for example, may not be the case this year. Certainly cash forecasts and budgets, you know, there's going to be a lot of volatility and uncertainty within those. If you have leases, then, you know, depending on what the organisation has done with any existing leases, early exit may have created before year end onerous lease provisions, which need to be considered, and I suppose that doesn't arise too often. Certainly with the rent relief that Lauren touched on earlier, whether that be a rent concession or a rent deferral, then there is some consideration that's required on how that is accounted for, especially with HLB 16. So assuming you're in the HLB 16 leases and you're not a short-term lease or a low-value asset lease, that doesn't need to be accounted for, I guess, as a right-of-use asset and lease liability. The question is, if you have received a rent relief or rent concession, how does that need to be accounted for? Good news is HLB did issue a tax alert, a technical alert which covers what the impact is. But just touching on that now, essentially the IASB has issued an amendment to HLB 16, which the HLB adopted, and that provided some relief around how that, and essentially simplified how any of those arrangements needed to be accounted for. Generally speaking, a modification, which when I say modification, a reduction in your rent or consideration for a period, more than likely would have been considered a modification. Under the relief, it can be treated as not as a modification and just as a periodic P&L, I suppose, gain in the period. Now you can elect to do that, and you don't have to. And I suppose there is some criteria to actually satisfy to obtain that relief. One criteria is that the rent relief must be granted for a period before 30 June 2021. So you can see the nexus there to it being a COVID-19 relief measure. And the other is that the consideration you've received or will receive should be less or equal to what the original lease term was. So again, it should be around relief that you've attained. So lastly, on the COVID-19, the director's report, there'll be some fair consideration, I'm sure, around what is going to be appropriate to disclose in the financial statements, and it should ultimately tie in with the financial impact in the accounts, and I'm sure that will involve some discussion with the auditors in doing that. Last point there, I couldn't help myself as an auditor just to sort of raise audit preparation as being key. as a firm, we're certainly getting ready, or if not ready, already well underway with many audits, and our clients are well underway as well. So I suppose just in terms of getting ready for this festive season, looking at documentation, is everything you need in order already. So for example, if you do want to record a bonus, has that bonus been documented in a way that you can record it? It meets the definition of a liability. I suppose many CFOs would really dislike the fact when auditors come through and potentially argue that that accrual isn't an accrual that you can record as an expense, perhaps for tax, but maybe not for accounting. So I suppose housekeeping there is just to make sure the documentation exists and it meets the criteria that's going to satisfy recognition. If in doubt, I would say discuss with your friendly auditor what that might look like. If there are redundancies that you're planning, again, do you have the constructive, have you passed that point where the redundancy should be recognised? Or if your intention is for it to be recognised after your end, then again, maybe you can't control that, but at least be cognizant of, that point. Certainly with JobKeeper eligibility, a lot of our clients, as Joel had mentioned, have benefited from that scheme. I suppose the last thing that we would want is for that to be incorrectly, claimed. So looking at the documentation there, and I say that in terms of the incorrectly claimed from an erroneous error, then it'd be important to ensure the documentation exists. Certainly, from an audit perspective, if it is material to the company, we would certainly look into that. Use our tax colleagues' expertise to, again, ensure that it all stacks up and the calculations are right. I think we'll be more favourable in terms of looking that closely than, say, the ATO. The other one to consider there is with the accounting standard changes, what has that done to your P&L? So, for example, WSB 16 is going to increase your interest expense, change your composition of your balance sheet. Has there been any potential change in your financial covenants that may or may not be breached, or may be breached down the track, and how do you manage that? Certainly, as an auditor, we would be keen, or it would be essential to see any waivers of non-action from our financiers before 30 June to ensure that the classification in the financial statements can be, for example, treated as non-current in the event of a breach, which would potentially enable a financier to recall the funds. Then ultimately that can lead to a classification as current, which 99% of the time causes a lot of headaches. So if that can be sought before your end, that would be a key action in the remaining days. And I suppose lastly, I say the easiest one to do is if there is a potential area that you consider to be grey or is new, or a major transaction and the accounting is not clear or is clear, I would certainly advocate having a discussion with your advisor or your auditor around whether or not that treatment is correct. Ultimately, just trying to avoid the disagreement or any surprises at the end. And certainly, if appropriate, given the uncertainty in the market, when it comes to valuations, assessment of impairments, where you're making key estimate judgments, if there is an expert that you can reach out to support your position, I would again strongly encourage engage in that discussion. Okay, that's me. So thank you. I think handing back to Joel now.
Thanks, Ken. So I thought just a few reflections on the current circumstance in terms of tax planning, and also to reflect on the economic environment and come back to that original point I was making in relation to what we see for corporates, some of whom are business as usual, some are a little bit reduced, and some who are metaphorically in the fight of their lives, really. So some things that we draw in common from our experiences of discussing with CFOs and finance teams around how they see the strategy going forwards for their businesses. Almost universally, there's a desire to maintain a high level of liquidity wherever possible, both to maintain operations if there are disruptions, but also because it's inherently difficult to predict the trajectory of the business environment going forwards into 2021 in a way that certainly I've never experienced, and I think a lot of our clients haven't really experienced either. And that need to maintain liquidity in business gives us a couple of extra things to think about in terms of this year end. For those businesses who have traded normally and profitably and successfully for that first 6 to 9 month period, and then have encountered something of or a significant downturn, there may still be potentially income tax payable. And in the current environment, that potential for income tax to become payable runs exactly a diametric opposition to a strategy of trying to maintain enough liquidity in the business to continue to be able to survive whatever shocks are there, but also to be able to reboot as the economy comes back from the current situation of reduction in jobs and incomes. And so that places a lot more pressure, I'd say, on the year-end tax planning process than has been the case in earlier years. So traditionally, year-end tax planning is an art form that probably hasn't changed much from year to year, but 2020 is quite a different environment from that perspective. The prospect of being quite uncertain about profits and therefore tax to pay in 2021, but having a knowledge that there might in fact be some tax payable or significant tax payable for 2020 means that it's even more important than ever to have your strategies nailed down, correct, and both not exposing you to too much unexpected tax cash flow, but also not exposing your business to tax risks that are not adequately managed. So a traditional one that's really important in this context is that, for example, a lot of businesses are looking at the quality of their debtors and their trade debtors in particular, of work in progress type amounts, of the recoverability of stock. And important things that you really should be looking at in this context, bearing in mind the need to manage liquidity, is to get in and assess the recoverability of your stock at year end, to have a close look at whatever trade debtors are there and make sure that they're written off. And for tax purposes, they must be written off before year end in order to claim a tax deduction. Also to have a good look at whatever assets are there, and to the extent that you have had something of a downturn in business, it might be time to really think about whether or not you have assets sitting idle that you no longer use or no longer intend to use. And in those circumstances, you might find it's appropriate to write them off for tax purposes, even though you don't actually cut the cord and throw the asset away. And all of these are extremely important in terms of managing whatever tax might be payable for the 2020 year, because of course, for those businesses who either expect to pay tax, have been profitable for 2020, but might well have a lot of restructuring costs or costs incurred in 2021, or just face quite an uncertain environment, it's quite important as to whether or not a deduction falls within June, or if it's deferred until July, might be a situation in which that deduction is correspondingly, you're not really sure when you might actually get a practical benefit out of those. So year-end tax planning need in those last remaining 4 days, very important to have your strategies set down carefully. One thing that we do see as being very important for a lot of taxpayers, not just those who are affected by the end of JobKeeper, is to look forwards to September. And for a lot of our time, we've talked about the JobKeeper program, which is important, I suppose, as a bit of a life support for many businesses, but for a lot of businesses also, it has prevented or stopped the planning for what will necessarily happen with the withdrawal of JobKeeper. It's currently scheduled to be withdrawn in September. Will be subject to a process of review in July, and some of the speculation around that looks at whether or not the JobKeeper scheme might be shortened in some cases, might be more carefully targeted, might be extended beyond September. And so that adds another element of complexity for businesses trying to plan. It's not just the businesses that we advise, but also for all of them to have resilience and enough liquidity to be able to deal with what will inevitably be some businesses that come to September and are not able to make the transition from having a workforce which is heavily subsidised to one which is potentially not subsidised at all. And so that's been called the cliff edge in a lot of cases. Coming back now to just the management of tax, for a lot of taxpayers, one strategy to ensure enough liquidity in their business has been to approach the tax office in the current environment, and we've found the tax office to be much more amenable to, or concessional in relation to, the way that they approach taxpayers who do have a tax debt. Now, partly that may be by government directive, but also it recognises the fact that the ability to pursue creditors in the current environment is restricted until the end of September. And on that basis, the tax office might not be able to pursue debts as actively as they would otherwise do, and very successfully do in most cases. So that's a sort of a second aspect there, is that we wait to see exactly how it is that the tax office will change its approach to receivables management when we get into the post-September world. And that may have impact both directly for businesses that we're dealing with, but it may also be that other businesses, other suppliers that our clients are dealing with, that reach a situation where they're no longer able to operate. And I suppose that's part of the reason why it's very important to be managing liquidity so carefully at the moment, because the macro effects of all of that are just a little bit uncertain. Another thing that we've had a lot of experience and seen quite a variety of different experiences in, was touched on both by Kinh and Lauren today, is that the rent relief which is provided to a number of tenants has huge implications for both landlords and tenants on both sides. From a landlord's perspective, the ability to be able to predict the trajectory of tenancies in the future creates a great deal of uncertainty, especially if there's really significant amounts of debt involved in the purchasing decision for real property which is used to let. Now, from a tenant's perspective, we see a range of different approaches here. In a lot of cases, in dealing with landlords, we have seen that landlords are most keen to acknowledge a reduction in rent only equivalent to the decline in turnover. And while this is, I suppose, an approach which has been sanctioned and mandated by the wider cabinet that's been involved in this, it doesn't really get down to the economics of the situation very effectively. And when I say that, I mean that for some businesses, the actual ability to use their leased premises as effectively to generate value from their leased premises has been reduced very much more greatly than the extent of the decline in their headline turnover number. A lot of businesses are going to face a situation where, coming out of the current situation where eviction is more or less impossible, we'll find that their continued lease is not really a viable or valuable aspect of their business that they conduct, even more so than any decline or reduction that they might be able to achieve through the rent relief scheme. And I suppose that's one thing where I see there might be quite a bit of fluctuation and turbulence going into October. Some businesses are just looking at the renegotiation of rents on a business as usual basis. That is assuming that the same premises, the same lease with the same assets will deliver the same outcomes into the future. I'd suggest that, particularly because the way in which many businesses and their employees approach the work environment has changed radically, that it's worth reconsidering whether or not your current leasing needs are going to meet your needs once your current leasing arrangements will meet your business's needs going into the future, and also to maintain a business environment where you can keep your employees safe and productive. And it's those aspects where I suppose moving away from looking just at the immediacy of gaining the rent keeper and gaining rent relief, we really need to look towards September and consider how best to adapt and be resilient to the changes that will come in the next 3 months to 12 months.